Hi friends, let us now get into the revision of another chapter, that is investment decisions or capital budgeting decisions. Friends, as we know, we always understand the concepts with the help of the names. So what is this investment decisions or capital budgeting decisions? Can we say investment decisions is nothing but decisions with regards to the investments to be made? Yes. And regarding the other name, that is capital budgeting decisions, can we say they are the decisions to be taken with respect to budgeting of capital? Absolutely yes. Now friends, coming slightly wider, in the earlier chapter, that is financing decisions, we said it is a study of or a decision making process of all the items concerned to the liability side of the balance sheet. Now with regards to capital budgeting, we can say it is a study of decision making with regards to the asset side of the balance sheet, that too the long term financial assets and more particularly the long term assets, the fixed assets. Alright. Now why are we doing this capital budgeting? What is the purpose of doing this? Very simple. Friends, in the earlier chapter of financing decisions, we said every rupee we generate, it has a cost. Absolutely yes. In the same way, every rupee we invest has to be optimally utilized for a purpose. Now, what is that purpose of optimal utilization? Okay, what is the purpose of our life ultimately on a financial note? We know to settle down. Okay, now zooming in to the CA course, to make money by telling others to make good money. Yes. Now zooming in further to the subject of financial management. What is the objective of financial management? To maximize wealth, that is wealth maximization? Absolutely yes. Now this wealth maximization, how do we maximize, is what we can learn with the help of capital budgeting decisions. So this is about the basic introduction of the chapter capital budgeting decisions or investment decisions. Friends, let us now move into the chapter and firstly understand what are the concepts to be revised quickly from this chapter. Concepts in capital budgeting. We have three major concepts. I am saying major concepts to be revised quickly. First one talks about computation of annual CF80s. What is CF80s? We already know this. Cash flows after tax. Now, why are we learning this first? Friends, what did we say is the purpose of our financial management of this chapter? To compute wealth maximization, to compute the benefit component. Absolutely yes. Now, we did not say profit maximization, we said wealth maximization. So, what indicates wealth for us? Our cash flows. Those cash flows after tax. Yes. Therefore, how do we arrive at those? The computation of those cash flows after tax is what we'll be learning initially. Then, we will move to the techniques of capital budgeting. So what are the different techniques we use for capital budgeting decisions? Capital budgeting decisions. Now, there are two types. We know one is traditional, the other is modern. What are traditional techniques? Conceptually, what are traditional techniques which do not involve time value of money? That is payback period or payback reciprocal, payback period, payback reciprocal, and lastly ARR. What is ARR? Average rate of return. Then what are the modern techniques? First we will talk about the discounted payback, because now what are modern techniques conceptually? Just like traditional, are those techniques which involve or include or consider the time value of money. Alright. Next, here comes the king of all the techniques, our NPV, followed by profitability index, then IRR, and lastly MIRR. So these are the techniques of capital budgeting. Now lastly we will see the application of all these techniques, that is types of capital budgeting decisions. Now friends, we are not going with the exact words of study material, but we are going with the same concepts. Now, what are types of capital budgeting? We have majorly 4 types. 1, selection or rejection. Next, selection and decision. Third one, comparison and decision. And lastly, replacement decision. So these are the types of capital budget decisions what we see. Selection or rejection, this project or that, should we select this project or reject this project? For that we will straight away use the techniques and say, for each technique there is a parameter with which we will decide. Okay, for example, for NPV, we will say if it is positive, you can select. If it is negative, you can reject. You have to reject. For profitability, we will say less than 1, reject. More than 1, yes. For IRR, if it is more than KO, cost of capital, accept the project. Less than KO, reject. Like this. The second one, selection and decision. Now, here we will take, in selection decision, there are again 2 scenarios, mutually exclusive and independent projects. Now, if they are mutually exclusive, we will choose the best of the lot. If they are independent, we will choose the best lot. Meaning what? Not just one project. If we can take more than one project which fits in our capital budgeting or fits in our capital rationing or in our budget basically, we will say yes, go ahead with that. Then, comparison decision, we will compare 2-3 projects with the techniques what we have, and finally we will decide which is the better project or the best project of all. And lastly, replacement decision. So there will be an existing machine or existing project which you want to replace with one more machine or one more project. By comparing the existing cash flows and the future cash flows or the cash flows of the proposal, we will say, we will compute not just NPV, we will compute the incremental NPV and then decide as to if the incremental NPV is positive, we will say yes, go ahead. If it is negative, we will say no, we will not go ahead. So these are the basic contents and concepts, the major concepts what we will have to learn from this chapter, capital budgeting decisions. Friends, before we get into the concepts or the contents to be revised in capital budgeting, let me tell you one very important point about this chapter. Capital budgeting or capital budgeting decisions or investment decisions, we can call it as the king of all the chapters in financial management. Now you may ask me, sir, how can we say this as the king of all when we have so many other important chapters? Yes, we do have other important chapters also, but if you look at this chapter, I am calling it as king from 2 perspectives. 1, theoretically we learn this here, but on a practical front, on a practical note, after you qualify and you start working, the application part of this chapter, capital budgeting, is very high. Now you may tell me or ask me, sir, with this numbers and all, our Excel sheet will solve by giving the formula or softwares will help us. Boss, they can only give the calculations, but they cannot give the explanations and logics. So you should be thorough conceptually to understand first and then explain to your clients. Now, secondly and most importantly, from examination point of view, friends, from examination point of view, if you look at the past question papers, I can say there will be hardly any question paper without capital budgeting decisions. I can say I think there is no question paper at all. Not just that, in majority of the question papers, you will find capital budgeting being the highest chapter with the highest number of marks. The chapter with the highest number of marks being capital budgeting is what you can see. Even in the latest examination, that is the November 2022 paper, if you see, capital budgeting has got the highest score. Now friends, not just that, it is also a very scoreable chapter. That is the numbers, you see, you have, what do you have in this? You have so many techniques, then application of those techniques. There are conceptual, some tricks to be applied, or there might be some twists to be unfolded during the examination, but majority, they are very scoring. The application part, whatever you learn here, if you apply it in the examination with the help of the formulae or with the help of the conceptual knowledge, it is very easy. After, I will definitely say easiest can maybe, highest scoring can be financing decisions, but the next highest can definitely be capital budgeting decisions. Therefore, please do not miss out on revising this chapter thoroughly, because it is a very easy chapter, very scoring chapter, and from examination point of view, as I rightly said, it is one of the most important chapters. Friends, let us now move into the revision of the first and the most important concept, that is computation of CF80. Computation of CF80. Now, what is this CF80 called? We know very well, cash flows after tax. Now, remember friends, This chapter is concerned with the cash components. That is why we will always talk in the language of cash only, not profits. But for a technique like ARR, rest of all the techniques will talk only in terms of absolute cash. Alright. Now, to get CF80, that is cash flows after tax, what should we be given? Cash flows before tax, absolutely. But we will be given not just cash flows before tax, we will be given cash flow before depreciation and tax. Usually, in most of the cases, this is what the question starts from. The question will give us, these are the cash flows before depreciation and tax. Another term for this is also, it can also be called as profits before depreciation and tax. Now, why are we calling it like this? Now, first of all, how did we arrive at this term CFBDT, that is cash flow before depreciation tax? Simple. We have our annual sales or revenues. Yes, we might add some annual savings to it. From that, we will remove all the cash costs, all the annual cash costs. Remember, cash costs, I repeat once again. What will we arrive at? This term only, that is our CFBDT. No, hence because sales minus cost, we will usually call it as profit. That is why it can also be called as profit before depreciation and tax. But generally, we will call it as cash flow before depreciation tax. Now, from this, we will remove depreciation. Why should we remove depreciation? Boss, you said we should not consider non-cash items. Yes, but there is one more catch here, tax. But this depreciation has got something called tax shield. That is, there is a benefit for depreciation in the name of tax. That is, your tax payment can be reduced. Therefore, to compute the exact or actual cash value of tax paid or tax payable, we will have to reduce it, because from the accounting purpose, how much will the tax be paid? Only based on reducing depreciation, and hence we will reduce depreciation, compute the tax component, and then add back the depreciation. And therefore, what will be the method? CFBDT minus depreciation will be called as PBT, or PBDT minus depreciation will be called as PBT. Now, from here, minus tax, what we will get? PAT. To this, we will have to add back depreciation. Why, sir? Because this is a non-cash item. This will give us the actual value, the most important value. What we want is our CFAT. What is this? Cash flow after tax per annum. These are all per annum numbers only. Absolutely, yes. Therefore, from CFBDT minus depreciation, PBT minus tax, PAT, we have to add back depreciation to arrive at CFAT. Now, as I said, friends, one golden rule what you're supposed to remember in computation of CFAT, they are cash flows after tax. Therefore, any items coming in the flow in the given question which are non-cash items, we will have to ignore them for the purpose of computation of CFAT. For example, you might have something called allocated overheads. They are not actuals. They are allocated on some rational basis. You will learn this in your cost and management accounting. Therefore, they are not actual costs. They are allocated costs. Any allocated cost, you will not consider here in computation of CFAT. Alright. Likewise, any sunk cost, we will ignore. Opportunity cost, we have to consider it. Now, here one technical catch is there. Why should we consider opportunity cost? Because if we had that opportunity and if we are not using it, it will become a cost for us, and hence opportunity cost will also be considered as a cash outflow for us. Alright, so this is how we compute the basic and the most important term in our game, that is our cash flows after tax. Friends, let's now move to the next and a very, very important concept, that is techniques of capital budgeting. Techniques of capital budgeting, decisions we can call it. We said there are two types of techniques. One is traditional, that is without time value of money. The other is modern, which is with or considering time value of money. Friends, let us quickly and briefly talk about time value of money. What is time value of money? Time value of money is nothing but the value of money over a period of time. Small example. I have 1 lakh rupees with me today. After 1 year, can I say the 1 lakh will be 1 lakh only? No, boss, I'll invest somewhere. I'll put an FD, or I'll invest somewhere in some company or shares, or wherever I will invest, it will generate some amount for me as a bonus, say in the name of interest. Therefore, this 1 lakh will have some time value of money after 1 year, say 1,10,000. Therefore, some techniques, they say, boss, 1 lakh of today is not equal to 1 lakh of tomorrow. 1 lakh of today should be 1 lakh plus tomorrow. Or in other words, after 1 year, if I say I have 1 lakh with me, what is the value of today? Can you still 1 lakh? If it has to be 1 lakh after 1 year, it has to be some 90,000 or 94,000, whatever, which can make or generate a fund up to 1 lakh. Absolutely. Friends, remember, time always, money always has a value over a period of time. One even more simple example to understand. Tell me something, 20,000 rupees some 20 years ago, is it same today? No. 20 years ago during my childhood, 20,000 was a very big amount. If somebody is earning 20,000, it is a very decent amount to live a great lifestyle, a very decent lifestyle. But 20,000 today may not be sufficient to live that much of life today. Why? As time flies, there are so many factors which will influence, and there is something called inflation, because of which the value of money will decrease if it is kept silent like that. Therefore, there are techniques which consider time value of money and which do not consider time value of money, and with those which do not consider time value of money are called as traditional techniques. What are they? Payback period. The extension is payback reciprocal, and the last one is ARR. Now, in modern, we said discounted payback period. There, the king of all techniques. As we said, NPV, then profitability index, then IRR, and lastly MIRR. So, payback period and this traditional techniques, first we will study about them, and then we will move to the modern techniques. Let us now move on to understanding the concepts of these traditional techniques very quickly. Friends, let us jump into the first technique in traditional techniques, that is our payback period. Payback period. Now, friends, not just about this technique, remember these golden words for any technique or for any concept, especially in financial management. That is, we are revising all the concepts, we are understanding all the concepts, or we are trying to recap all the concepts, but the actual understanding of these concepts only happens when you correlate with them with the problem solved, or when you solve the problems again with the help of these concepts. Therefore, simple understanding, listening of these concepts or you think understanding of things may not help you completely. Therefore, for that we will have to also refer to the problems which we already solved, or you may have to resolve the problems and then understand it thoroughly. Therefore, we need the help of practical problems, which I hope you will definitely do it. Now, payback period. Now, what is this payback period? I said we will always understand things from the name itself. Payback. Period. The period within which, what is paid back? The investment is paid back is called as our payback period. I repeat, the period within which our investment can be paid back, or in other words, to put in simple words, the time taken to recover the investment through the cash flows is called our payback period. One last time, the time taken to recover the investment made, the initial cash outflow, the initial cost made through the annual cash flows is called our payback period. Now, mathematically, how do we arrive at it? It's again, mathematically with the help of some numbers, we will say, for example, my initial investment is 10 lakhs. And every year, my annual cash flows, what I am generating, are expected to be 2 lakhs. Now, what is the payback period? Simple. 10 lakhs is my investment. Every year 2 lakhs is a CFAT. So, 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, 10 lakhs. So, can I say 5 lakhs? Sorry, 5 years? Absolutely. Now, how did I get this 5? Very simple was 10 lakhs by 2 lakhs. Now, what is 10 lakhs? Our initial investment. What is 2 lakhs? Our annual CFAT. Therefore, payback or payback period is equal to initial investment divided by annual CFAT. Now, this annual CFAT means what? It is something nothing but per annum. Therefore, this per annum goes denominator of denominator, it comes to the numerator. Therefore, how will we call it as? In what terms? We will call it in years. If we take the annual CFAT, if we take the CFATs just in case in multiples of months, then we will call it months, but generally we will compute only payback period in years. At times what happens, this is when the cash flows are even. What if the cash flows are uneven? Say for example, same example, 10 lakhs is our initial investment or initial cash outflow. Say my cash flows are like, CFATs are like 2 lakhs, 3 lakhs, 3 lakhs and 4 lakhs. Now, within what period am I able to recover this initial investment of 10 lakhs? Okay, 2 by end of first year. By end of second year, 5, 2 plus 3, correct. Then by end of third year, 5 plus 3, 8. Now, by end of fourth year, it is 12. Therefore, I will not say full 4 years. Boss, I am recovering somewhere in between year 3 and year 4. So, we will call it year 1, year 2, year 3, year 4. Correct? Yes. Now, these are CFATs. These are cumulative CFATs. Now, therefore, what do we say? Acha, by end of third year, we recovered how much? 8 lakhs. Now, how much is the actual recoverable amount? 10 lakhs. Now, what is the amount yet to be recovered? 10 lakhs minus 8 lakhs. Therefore, 2 lakhs is the amount we have to recover. Now, but what is the amount recovered in year 4? 4 lakhs. Okay, so for 4 lakhs, it has taken 1 year. For 2 lakhs, how much time will it take? Simple. 2 lakhs into 1 year, sorry, to 1 year by 4 lakhs. This is nothing but half year. Therefore, can I say now my payback period in such a case where cash flows are uneven is nothing but 3 plus half, that is 3.5 years. So, this is how we compute our payback period. Now, how is this relevant for our capital budgeting decisions? Friends, we have some target periods given to us. Say for example, if the target period given to us is 5 years, in case 1, we said it is taking how many years? 5 years, okay, 5 years. In the first example we took 10 lakhs and 2 lakhs, 2 lakhs. So 5 years matches, doesn't make any difference for us. Now just assume if our payback period we have arrived at 4 years. Now target is 5, our payback is 4. Therefore, is our payback better than the target or not better? Now, don't say 4 is less than 5, therefore not better. Boss, the time has to be lesser than the target. Only then it is considered to be a considerable project. Therefore, can we say, acha, if the payback period of the project is less than the target period, the project can be chosen? Absolutely yes. And what if the payback instead of 4 years, we arrive at some 6 years? Then we will say, no, it is not. Say for example, in this example, if the target period is 3 years, will we choose the project or no? The payback period what we got is 3.5 years. It is more than the target. We are taking more time than what is actually targeted. Therefore, the project will be rejected. This is how we decide to choose or not to choose a project based on the technique payback period. Let's move on to the next one, a slight extension to payback period, that is payback reciprocal. Payback reciprocal. Now friends, as the name suggests, it is a reciprocal of payback. What do you mean by reciprocal? Inverse of whatever is payback. Now what is the payback period formula? We said payback period is equal to initial investment by annual cash flows or annual CFAT. Therefore, what will be the reciprocal? Payback reciprocal will be equal to inverse it. Annual CFAT divided by initial investment. Now you will have a doubt. Obviously our annual CFAT will be much less than the initial investment. Then how do we compute? For this ease to a computation, they have multiplied with 100. Okay. Now to understand the concept better, we will take the same example of earlier. That is 10 lakhs being the initial investment, 2 lakhs being the annual CFAT. Now what happens here? 2 lakhs by 10 lakhs into 100. So 5 times and this is 20%. Now friends, now with the help of this number we will understand what is the meaning of payback reciprocal. See, it is inverse of payback, no doubt, but conceptually what does it speak? Conceptually it says, boss, payback reciprocal is nothing but the percentage of recovery of the initial investment through annual CFAT. In other words, annually every year through CFAT, what percent are you able to recover out of the investment is nothing but our payback reciprocal. It's a very small concept. So, it is just an extension of our payback period. Therefore, what is payback reciprocal? Conceptually, it is the percentage of recovery of the capital or the initial investment made per annum, which will calculate by annual CFAT by initial investment into 100. Friends, let's move to the next technique, that is ARR, which is called as average rate of return or accounting rate of return. Now, in short, we call it ARR, not RRR. Now, what is ARR saying us? It is called as accounting rate of return. Friends, trust me, this is the only and only technique which considers profit and not cash flows. Now, you may ask me, sir, you said initially we will consider only cash flows. Yes, definitely, yes, but this is one of the methods. See, different people may follow different methods. Therefore, this is also one of the methods, but don't worry, this is a traditional technique, not in application much now, but still we have to learn what it is. Alright, so what is ARR, accounting rate of return? When we say accounting rate of return, rate of what? Return. What is our accounting return? Nothing but our profit. Okay, not simply profit, it is average profit. Therefore, if the tenure of the project is 4 years or 5 years, we will take the average of all the 4. 1 year it may be 90,000, 1 year it may be 1,20,000, 1 year it may be 60,000, whatever it is. If it is for 4 years, we will add all of them, divide by 4. For 5 years, add all of them, divide by 5, like this. Therefore, we will consider the average profit per annum. Alright. Now, it is rate of return on what? There has to be some base for it. On what basis will you calculate the rate of return? It is, though the word is missing here, conceptually, ARR is the accounting rate of return or average accounting rate of return on investment. Therefore, ARR is equal to average, what is our accounting rate of return? PAT divided by investment, again into 100, because it is our rate. Rates we always express as a percentage of 100. Now basically ARR, this is the basic formula, that is average PAT, this is per annum, that is why we are taking an average for it, divided by investment to 100. Now a slight extension to this. Somebody asked, somebody thought maybe, when you are taking average PAT, why don't you take average for investment also? Meaning, investment initially, say for example, is 10 lakhs, the cost of the asset or the machinery, whatever. By end of life, what is happening? The 10 lakhs is becoming 0. Yes. Therefore, should we not take 10 lakhs and the average of 10 lakhs and 0? Absolutely yes. Therefore, 10 lakhs plus 0 by 2, considerable. Now, the another way of expressing this formula, average PAT by average investment into 100, where average investment is equal to, there is no scrap value, salvage value for this. So, initial investment divided by 2. Now, this is the case when there is no salvage value. You know, what if there is salvage value? Now comes another tricky point. Alright, we will redefine the formula. Now, this will not change. The average investment will be the same. But if there is salvage value, what is the average investment value? That will change. How will it change? Now, if there is no salvage value, but if there is salvage value, average investment will be what? I will write down the formula first and then explain. It will be initial investment minus salvage value by 2 plus salvage value. Here I will write if there is salvage value. So now what is this formula? How did we arrive at this formula? The explanation for this formula is, the logical explanation, conceptual explanation is, was initial investment is becoming, is reducing to some value, say 10 lakhs is becoming some 2 lakhs, therefore for what should you take the average? 10 lakhs minus 2 lakhs, 8 lakhs ka average we have to take, yes. Then why not a salvage value by 2? A salvage value is there from the beginning till the end as same, that 2 lakhs whatever is there, it is there in the beginning, it is there in the end. Therefore, if you have to take an average, how do you take an average? It is the same. Why do you have to take an average for it? Therefore, the initial investment minus salvage value by 2 plus the salvage value will be the formula of average investment when there is a salvage value given. But otherwise, conceptually, what is the formula? The most popular formula is this. So, if the specification about average investment, then we will choose this, and this is about our ARR, that is average accounting rate of return.